Hey everybody, Mike DeSepoli, Heritage Financial Advisory Group. Happy Friday. Welcome to the Heritage Market Pulse for Friday, March 18th, 2022. A lot going on in the markets this week. A lot to update you on this market, this economy, and Federal Reserve policy. So let's get right to it. The big Federal Reserve this meeting this week, a lot of anticipation. Really, folks and investors have been looking forward, I don't know about forward, but have been anticipating this meeting in March 2022 for about 6 months now, where the Federal Reserve, as widely expected, approved the first interest rate hike in more than 6 years. They raised the benchmark rate from 0% to 0.25%, going ahead with that 25 basis point increase, right? A couple months ago, everybody was telling us, was sure about the fact that it would be a 0.5%, not a 0.25%, but here we are, 0.25%, still forecasting 6 more interest rate hikes ahead for the rest of the year. So we still don't believe the 6 will happen. I think it'll be less than that, but nonetheless, the market got the rate hike that everybody was anticipating, and it's a good thing for the market to clear this hurdle because we have been talking about interest rates for quite some time. So I know what you're thinking, right? 25 basis point increase. The federal funds rate is probably exceptionally high right now, right? Well, let's take a look. And not quite, right? This is the narrative that the media has built into these markets, that interest rate increases are bad for stocks. We have been telling you over and over, pounding the table, interest rate hikes are bullish. They're bullish for stocks. History suggests that. And beside the fact that we are not in a restrictive interest rate environment, folks, look at the federal funds effective rate just going back to 1980. I'm sure many of you home buyers in the early 80s remember that mortgage rate at 15, 16, 18%. Right, so the notion that moving rates from 0 to 0.25% is high is just absurd, and the fact or the insinuation that that interest rate increase should throw the economy off the rails is just utterly preposterous, right? But the media promised us that this was bad, so this must have been bad for stocks, right? So let's take a look at the market. So this is a 3-year view of the market. I wanted to start with a longer term view as well because we had a very powerful move, a bounce off of these recent lows. And on this chart, each candle represents 1 month. So what started as a very poor month in March has very quickly turned around. Let's zoom it in a little bit. Let's take a look at this week in the markets. And well, what do you know? After starting lower on Monday, markets have been up and away for the remainder of the week. A very big move in NASDAQ. We're looking at about a 1,100 point move Tuesday through Friday, right? That's a big move, but I know what you're thinking, right? The media promised us that rate hikes were bad for stocks. So what in the world is going on? Well, the fact is, folks, that the narrative around interest rates has been so twisted that many people have fallen into the trap to believe that an interest rate increase of 0.25% was going to be the death knell for stocks. So again, we still don't think it is. We still don't believe it is. History suggests that it's not. But nonetheless, let's take a look at our heat map and see how markets are shaping up. Today, we're about midway through the trade here on Friday the 18th. Pretty mixed market, right? Markets come a long way in a short period of time this week. Kind of like a sprinter, right? Needs to catch its breath a little bit. That's quite all right. So we have a little bit of a mixed tape. But when you take a look at the 1 week performance, right? Really great week across the board. Broad-based rally. And continuing about what we spoke about on Tuesday, one of the most important things to take note of with this chart is not just that it's a broad-based rally. Of course, we love to see all sectors participating, but the fact that energy has really started to give it up recently in a reversal of trends where energy was so hot and other stocks could do nothing right. Now we're starting to see that reverse a little bit. So could be just a short-term pullback for energy. We do believe, we all think prices are going to go a little higher as some of these supply chain issues get sorted out. But nonetheless, this is what you want to see, broad-based rally, and then some of the recent hedges, right, the areas of the market that have gone in the opposite direction, energy and commodities, we're seeing them back off a little bit while stocks get a nice bounce. So checking in on investors. Sentiment, right? Investors feel a little bit better today than they felt on Tuesday and last week. When we checked this on Tuesday, we were in the fear category at 15, right? We've moved up a little bit higher to 34. Still scared. Investors are still terrified out there. And again, can't really blame them. It's hard to tell which direction this market's going. We're down 1,000 points, then we rally 1,000 points, right? Volatility remains, but it's good, it's healthy, it's flushing its way through the system. and we're starting to see that volatility gauge, that volatility index, they call it the VIX, we're starting to see that come back down, which is a good sign. That's one chart you want to root on going down, because as volatility comes down, more normal market conditions will return. So all in all, let's just go back to the market for a second. We still have some work to do, but the market is really working hard to put in this bottom here. If you look at a lot of the individual names that we own, they're actually shaping up and forming bottoms a little bit earlier, a little bit ahead of the market, which is a good sign, because when markets get battered like they have over the last 6 months, it's the stocks that initially gave the warning signs that there was a move lower coming. Those are the ones we want to see lead us out of it. So far, so good on that front. Again, we still have a lot of work to do, but to see this type of a sharp rally on the back of a Federal Reserve interest rate increase, right, that everybody expected was bearish. Well, almost everybody, not us, but everybody told you it was bearish. The media's been pandering to this for 6 months, that the interest rate increase was going to knock the stock market down. I think the important thing I'm trying to convey here is not to pick on the media. That's certainly not the point. But folks, the market is a forward-looking indicator. So while everybody was waiting for Wednesday and waiting for that release for the Fed to actually raise interest rates, markets moved to price these things in months ago, right? And it's been our belief, and it continues to be our belief, that not only has the market priced in an interest rate increase, it's priced in 7 of them. And if we come anywhere short of 7, right, the markets are going to see that as a dovish, as a supportive monetary policy development, and that will be good for markets. So a little bit more brief today. Not a lot to update you on. Today, there'll likely to be a lot of volatility, as Fridays have been lately, right, going into the weekend. Some people a little nervous about the news flow coming out of Europe. So remains to be seen where we go from here. But the market is doing the heavy lifting, the necessary work that we want to see it do. Got a couple, I think, actually, as a point of data here, markets up 3 days in a row, working on 4 days in a row. Okay, it's a few hours to see where we go with that. But we hadn't been up 3 days in a row in 3 months, right? We haven't been up 4 days in a row in probably going back to, I think it's early November, right? So just shows you how tough the market conditions have been. But again, folks, this is corrections, right? Like I told you the other day, corrections have 2 goals. First, they want to wear you out, and then they want to scare you out. And if we continue and stick to the plan and allow the data to dictate where we go next, we will get through this correction like we have and many others in the past. So we hope you have a great Friday and a great weekend, and we'll see you back on Monday for the Heritage Market Update.